Welcome to Sweatpants to Suits, the podcast where we dive into the journeys of career professionals, uncovering the secrets to transforming from sweatpants mode to suits success. Join us as we explore personal stories, insights, and strategies for cultivating a growth mindset and achieving your vision of success. I'm your host, Jerry. Are you ready to up your game? Let's dive in. Steve Selengut is on a mission to empower financial independence. As a veteran investment manager and advisor for 40 years, he shares insights into how he turned a side hustle into a $110 million career. Join us as we discuss retirement money secrets, his latest book, and learn how to make prudent investment decisions, especially for beginners. It's an absolutely amazing story that you turned a side hustle to a $110 million career, Steve. How did your journey start as a portfolio manager?
Well, I started off as managing my own portfolio. I know a lot of people get out of school or out of college and they say, I'm going to go into the financial services business, and they take some tests and then they have to start advising people how to invest their money with really no personal experience. I didn't do it that way. Do you know the expression, choose your parents well?
Choose your parents well.
Yeah, I chose my parents well. So I came into a nice chunk of money when I was 25. It was money left over because I didn't go to an Ivy League school. I went to a small college. I had put away a lot of money from working since the time I was a teenager, mowing lawns and things like that. So when I was 25, my father smacked down on my table a manila folder. I opened it up, shook it up like this, and out came stock certificates, which people today don't even know what a stock certificate was. But it was just the proof of ownership, just like you have a certificate of ownership of your vehicle. You know, you've got that proof that you own it. This is proof that I owned 500 shares of General Motors. Okay. So I had a whole bunch of those stock certificates, all big companies and all dividend paying companies back then. And my job was to not lose it. That's the the message I gave myself. I'm not going to lose this money. I'm going to invest it wisely. And so I got the help of actually it's very unique. I got the help of a woman broker. And in those days, there weren't a whole lot of them around. So anyway, she and I studied what we had, and this is something people should do. They should do the background check, get in there and look at what does General Motors do? Of course, you know them, but what if it's some company you just heard about on a podcast? Who are they? What do they do? Are they profitable? This, that, the other. All those questions we asked. And I tracked how the price has moved up and down over the previous years. And I realized that not only do they pay dividends, every one of them paid dividends, as, that's a sign of their quality. It's a sure sign of quality of a company if they pay dividends. And the other thing was that they were very volatile in their price movements up and down. I know a lot of people fear that today. Oh my, you hear the market was volatile today, watch out. I crave that because what it means is that you can buy it at a certain level and then it goes up you don't know when, but when it goes up, you can sell it and then you can do the whole thing all over again. So what I did, I had probably about 50 different companies at that time, and I would trade them regularly and collect the dividends and reinvest it. And I started adding to my portfolio non-stock investments like bonds. And bonds are debt securities, unlike stocks, which are ownership securities. So I built up about 30% of my portfolio I put into these income purpose securities. So, with the market and the trading and just general things, by the time I got to be, when 1979 rolled around, I was 34 years old. 9 years later, I had, a large portfolio, with a high six-figure portfolio, and it was generating almost 5 times as much money in income from both sources, the dividends and the profits, as my salary. So
Wow.
I determined that it was time to quit that job and start my own business. And I had a track record that I could show people. Here I started. Here are my account statements year after year. This is what it is today. I can do that for you. So at that point, I had to take a lot of tests to get licensed and do all that kind of stuff. But that's how it all started.
Just a question. So you don't need a college education to become a portfolio manager. And one of the wise decisions that you did was put that college fund into investment portfolio.
Oh no, I put the college fund. That was the excess. I didn't go to an Ivy League school. I went to a small school, but I did go to college. And I'd say it's essential. And if you want to go into the business, I think you got to get into business and economics courses as well.
Business economics. Oh.
Yeah, as well as that to get a sense of what these things are all about. I mean, I've spoken to people, Jerry, in my coaching business who really don't even know what a bond is. They don't know the difference between a preferred stock and a common stock. And I'm sure, I could explain that. But people don't get the education and investments that they really deserve. Most of your audience probably is getting into investments now by being in their 401k plan.
Oh,
That's where most people today start. We didn't have 401k plans in my day. We had employee savings plans, and we didn't have a choice of how to invest things. We could pick whether we were going to be in the stock market or the bond market. That's the only thing we could do. Today, I know you have your own choices. You can put it in these mutual funds or those mutual funds, ETFs, company stock. You can do a lot of things. But a lot of people today don't even know that their 401k is in the stock market. A lot of young people today probably don't realize that they own a lot of the companies that they get really angry with for how they do business.
there's a lot of investment instruments. Would you say that that's a good thing? And what are some barriers to entry to this complicated world of investments?
The only complications are the regulations. You must pass a whole bunch of tests, various series tests, depending on what type of business you're going into. If you're going to become a person that actually places orders for people, it's one set of tests you have to take. If you're going to be an advisor like I do that takes over the management responsibility of portfolios, and then I call the broker and tell him what to do, that's actually a less intense set of tests, but you still have to take tests, and they're not easy. They require some book reading, some experience, but that's really the only barrier. Finding the next barrier, I think, with financial professionals today is their own focus, on whether they're focused on what their bosses tell them to be focused on, or whether they're focused on their clients and what their clients need. And that's where I have my biggest separation from the mainstream. We used to work our business through big companies that finally got taken over by Wachovia maybe 15 years ago. And then it started where they wanted me to stop managing the money and to refer all my clients to their investment managers to put it in their products. So we left them and we got an independent broker dealer at that point, which we had our independence from doing that type of thing. But today, if you go into the field and you're working for a Merrill Lynch or somebody like that, your main objective is to grow the market value of the portfolio and not the income that it produces, because everybody gets paid based on market value.
Market value.
So go ahead.
All right, thank you so much. So just to clarify, if you want to work on Wall Street, you need that bachelor's from like Ivy League school. But if you're looking to serve people, there's still ways to become a financial advisor by taking a different test.
Yeah, you can take tests either way. If you go to Harvard or if you go to Gettysburg like I did, you have to pass the same tests.
Same test.
You might, but you'll probably get paid more by your boss if you went to Harvard than if you went to Gettysburg. Okay. So
Looking at your portfolio, what are some advice that you recommend people to invest in? Bonds, IOUs, stocks, and what kind of ratio are you looking at?
what do you mean by IOUs?
Like IOUs, CDs.
Oh, CDs are savings accounts, really. The bank promises to pay, they can guarantee it. It's not an investment.
Not
That's a savings account. One thing that all investments have is the risk of financial loss. The company can go out of business. The state can say, I don't care if we did borrow that money for you on this municipal bond, we're not going to pay you. Governments can do that. They don't. I mean, it'd be very costly to them to do it. You see what's going on in Congress every few months. They have this big, I'd almost call it a sideshow about whether or not they're going to approve the budget or stop operating. I mean, that will affect the debt markets like crazy. But, so I think I've lost track of your question, but that happens with people my age. So help me out here.
No worries. Thank you so much. So what should you be looking to invest as a beginner? Stocks or bonds? Or should it
stocks have more risk than bonds. Stocks represent ownership in a company. So let's say your uncle just decided to open up a pizza parlor. His first effort, and he said, I want you to own a piece of the action. Would you consider that a safe investment or a real speculation? How do you know if his pizza is going to sell or not? So on the other hand, if he said to you, I'm going to sign a piece of paper that says I'm borrowing $10,000 from you, then you have a legal document that says even he goes broke, he still owes you 10 grand. The one is a stock, the one is a bond. Bonds are always safer than stocks. When you're first starting to invest, as you heard me say earlier that I did, one of the important things is to start putting some of your portfolio in income producing securities. And that's mostly bonds, mortgages, some forms of real estate, other types of government and corporate debt securities. And not to get all hyped up that you think you're going to pick the next Microsoft or Amazon, you're going to guess on this one. Oh, this technology looks really good to me. I'm going to put my money in there. Over the years, when I used to get new clients in, I'd have a look and they'd show me their regular portfolio or this, that, and the other thing, and they'd show me their IRAs. And this was way back when the maximum you could put into an IRA was $1,500. That's when they started. So I'd get this woman. I remember this young woman who came in and she had $1,500 in her IRA. And I said, oh, you just started an IRA. Great. Let's look at what we can do with that. She said, no, I didn't just start it. This is my fourth payment. I said, what happened to the other ones? She said, they all went to zero. So she'd been, a broker had advised her, buy this, buy that, buy this, or whatever, and none of them panned out. So, so that's what I'm getting at. When you're starting first, you want to be as safe as possible. Then when you build it up, let's say you get the year-end bonus 2 years in a row, and now you got $20,000 in your portfolio. Then you can start saying, I'm going to put a little bit into the stock market. Okay. And at the bigger you get at a young age, the more you can put into the equity markets. When I was starting, and I told you that I started with a tidy sum, I had 70% in the stock market and 30% in the income market. By the time I got to be 50s, in my 50s, I was more like 50-50 between the two. And then into my 60s, I'm not into my 80s yet. Into my 60s, I got to be where I am now, 70% in income and 30% in the stock market. And that'll depend on how big the portfolio is, your experience, all these other variables. But you got to start safe, then you can become more aggressive, then you got to get safe again when you get older. So it's kind of that kind of a cycle that depends on your age. So you want to find income securities, which is hard and easy at the same time. It's hard to get advice on them because most professionals want to sell you a complete bond or something like that, or an ETF that might contain these things, which is better, or a mutual fund, which is okay. But I use a thing called closed-end funds because they really produce a lot more income while being as well diversified as the other two. Closed-end funds are trust vehicles. Like, let's say people in your parents or their parents have set aside their money in a trust to be taken care of by somebody in the event they die, so you can get that. That's a trust. And these trust vehicles are required by law to pay out 95% of their earnings. So think about Amazon. If they had to pay out 95% of their earnings, the dividends that they'd be paying to shareholders would be pretty substantial, right?
Mm.
But
Right.
they're not required to do anything. So whatever they pay, they don't pay very much. But these trust vehicles, these closed-end funds, are a huge portfolio of bonds and mortgages and real estate and stuff like that. And they pay out every month. They pay out sizable amounts of interest, much more interest than a bank would be paying. And they fluctuate in price just like a stock. So you can sell them if they go up. You can buy more of them if they go down. But you can buy them if you've got your first $2,000 that you want to invest. You can buy 200. You could buy 2 or 3 different closed-end funds for $2,000 and start off with a pretty diversified unit, paying you about 9%, and not have to
Here's a
worry
quick
about it.
question.
Yeah,
Here's a quick question. How much money should you start with as a beginner?
whatever you can put away.
Whatever you can put away.
Yeah,
And
start as soon as you can. Doesn't matter if you start off with the bank account, the savings account with $100 a month. Put it away, and then as soon as you get like $1,000, then start looking. Go to 2 places. Get yourself an account at some place like Fidelity or Schwab. Somebody will work with beginners. Put the money in there and start buying what I do. And that is closed in. I think they're perfect for kids and grandkids and newbie investors because they're diversified, so they're less risky. They're, there's so much, and I talk about that in my book, which you can see over my corner there, Retirement Money Secrets. I list all these, how to determine quality, how to diversify, how to make sure you're getting income, and when and how to take profits. These are the things you got to think about, even with a very small portfolio. But you got to start as soon as you can. Start as soon as you can. And you'll be surprised how quickly the income grows and how secure that'll make you feel as you get older. Particularly when you start thinking about putting kids in college. You have your first child and you're saying, oh my God, I got to put this kid into a college where it's going to cost me $100,000 a year for tuition. You got to start saving. You got to start saving right away. So
if I started with $100, right? For example, somebody may start with the teeny tiny amount. They can't buy much. So if they throw away like $100 at an investment, what sort of investment would you consider?
No, I'm saying that these closed-end funds, I mean, you can buy 100 shares. There are ones you could buy 50 shares of at $2 a piece.
$2.
Yeah. you could buy one of these closed-end funds. It's a big portfolio of securities paying 8 or 9%, and you can buy it in that small of a portion. But I would wait until you got, I don't know if a broker would take it. You'd have to set up an account at yourself with Fidelity or Schwab, like I said. And I don't know if they have minimum requirements. So go online, find out what the minimum requirements are. Call up your dad and say, Dad, I'm going to start. I need $500 to set up an account. Help me out with that, and I'll take care of the rest. Do something like that. But as soon as you can, set up an account. And there's places you can go, and I talk about them in the book, places you can go to investigate closed-end funds. It's a website called CEF Connect. It's very easy to go there and take a look at what these things are and how much they pay, how long they've been in business, how stable their distributions are. You can look at all that detail stuff. And then little by little, you can get into those, and you can even buy a couple stock market ETFs after you get a little bit more experience. But I would make sure you focus on income first.
Income.
Yeah.
Definitely. So what is the mentality of a successful investor? I know that there's a lot of news throwing around saying that North America is going into like this a recession or something like that. How do you stay sane?
Well, I guess you have to remember that education I was talking about? Most people don't know what a recession is, other than that they think about the Great Depression way back in the 20s when, there were soup lines and people on corners with cups. All a recession means is a couple consecutive quarters of lower gross national product. The sum of all the businesses in the country goes down 3 quarters in a row. That's called a recession. And as scary as it may sound, the impact on the average guy is not very high. There can be lower employment during them, and it's likely that there'll also be lower interest rates to make them go away. But the average guy, is not going to lose his job in that type of thing. And if you're in a professional position, it's probably not going to affect you at all. But the stock market will go down. But if you're in these closed-end funds like I am, it's an opportunity to buy more money, more income cheaper when the market goes down. So the market is a cyclical thing. People like to think that it just goes up. It doesn't just go up. It's never just gone up. And even if the Jim Cramers of the world think they can tell you when it's going to go up or go down, they really don't know. You never know when airplanes are going to fly into a building, right? Nobody knew.
Right.
So things happen that you cannot predict. But if you understand the market cycle of where you are, like right now, income securities are down, very down, because we just had rising interest rates. And it's like the scales of justice. If interest rates go up, prices go down. If interest rates go down, prices go up. Always. There is no way to avoid that. It will happen. Stock market, on the other hand, you don't know where it's going to go. Okay? So when prices are high, you say, okay, prices are high. They've been high for a while. They're going to go down eventually. And they will. You don't know when, but you can prepare for that. Number one, you take your profits when the prices are high. And when you buy back, you don't buy as much as you would have bought if the prices were lower, but you still can buy it, because if it goes down, you can add to that position so that you'll be better able to take advantage of it when it goes back up again. So those are the types you develop these techniques, these processes to take advantage of the market cycle. So a recession makes you smile. Prices are going to be lower. I can buy more of the securities I own. I can buy new securities cheaper, and they still all pay me nice money in distributions. And then to the other hand, the market's up. Great. I can take profits and I can reinvest again, the same type of scenario. I'll just be careful not to put as much into ABC company as I would have if the prices were lower. That's all. So you get to the point, you have to get to the point where you're comfortable in either environment, whether the market's up or down, you know how to take advantage of that situation.
Wonderful. I think that's a good key takeaway as well. By staying in the market, you're able to grab the things around and embrace recession as the opportunity to get more shares of a wonderful investment. Thank you so much, Mr. Steve Selengut. It is an honor to interview you today.
Well, thank you. It's a pleasure to be here with you, Jerry.